Hi friends, good morning. Welcome to my channel. Hope you are all fine. Today our topic is net income approach, one of the capital structure theories. This is very simple. Come with me. Let's finish this in just 10 minutes. Before going to the topic, we need to see about the basic assumptions of capital structure theories. The first assumption is there are only two types of funds, debt and equity. There is no preference share capital here. The second assumption is the payout ratio is 100%. It means if we see the profitability statement, the net income is totally distributed to equity shareholders. Nothing is remained in the company. The third assumption is there are no taxes at all. Taxes are not considered. Either it may be income tax or dividend distribution tax. No taxes are considered here. The fourth assumption is business risk remains constant over a period of time. What this means? If we see the profitability statement, this means the EBIT should remain constant over a period of time. The EBIT is expected not to fluctuate. This is the fourth assumption. What is fifth assumption? The total financing should remain constant. What does this mean? For example, if we are using 100 crore capital, that should not be changed. You can change debt equity proportions, but the cap of 100 crore should not be disturbed anyway. The next one is firm has perpetual life. It means it is expected to continue in future. These are the assumptions, and the main important line of any capital structure theory is these capital structure theories explain relationship between three items. What are those three? First one is overall cost of capital, second one is capital structure, and third one is the value of the firm. These are the three items we have to keep in mind. Okay, this is all about the basic, and let's come to our main topic, that is net income approach. This is one of the capital structure theories. Okay, what this theory says? This theory suggests maximum possible debt usage. If possible, use 100% debt. Then your firm will get benefited. How? Your overall cost of capital reduces and the value of the firm increases. As we discussed earlier, there is relationship between these three items. Which items? How the relationship is established here? If you use maximum possible debt in your capital structure, first item, then your overall cost of capital will reduce, the second item, and the value of your firm will maximize, the third item. We can see this in the form of a graph. Conversely, it can be said like this. If we don't use debt, then we are at a disadvantageous position. Our overall cost of capital tends to increase and the value of the firm will decline. Let's see this in the form of a graphical presentation. If you observe this graph, you can see the overall cost of capital is declining when the debt proportions are increasing in the overall cost of capital. Please see this. The colors indicate debt and equity portions. In the initial instance C, we are using higher proportions of equity and lower proportions of debt. At this situation, the overall cost of capital is at a higher rate. Slowly and gradually, when you are decreasing the equity proportions and increasing debt proportions, the overall cost of capital tends to decline. See the curve, it goes down when you use higher proportions of debt. What this means is, if you use higher proportions of debt, your overall cost of capital will decrease. We have seen net income approach, and moreover, we said there are three items: capital structure, value of the firm, and overall cost of capital. Then you will get a question, you will get a doubt, how we can know these things. First one is capital structure. What this mean? For example, in our 100 crore capital, 80 crore is debt and 20 crore is equity. This is the capital structure. It's very easy to know. It's a no-brainer. Now, the second one is value of the firm. There is a simple formula for this. Value of the firm is equal to market value of equity plus market value of debt. Market value of debt is nothing but the amount of debt you brought into the business. It's simple, but it's not the same for equity. Why? Because the net income fluctuates. For debt, the interest rate is constant and the interest amount is same. So the market value of debt also remains same. But for equity, there is a fluctuation always in distribution of earnings. So how we will get value of equity, that is market value of equity? There is a simple formula. Market value of equity is equal to net income available to equity shareholders divided by cost of equity. How we will get net income? If we see the profitability statement, after payment to lenders, the interest amount, the remaining is the amount available to equity shareholders. Now, if we add the market value of equity and market value of debt, we will get the market value of the firm. And the next one is overall cost of capital. How we will get overall cost of capital? For this, again, there is a formula. Overall cost of capital is equal to EBIT by value of the firm. We know the value of the firm because we computed earlier. Where is EBIT? Again, we have to take a look at the profitability statement. Why we are taking EBIT? Because this EBIT earnings amount is that amount which is distributed to both sources of finance, that is lenders and equity shareholders, in the form of interest to the lenders, in the form of dividend to equity shareholders. So that is the total figure which is distributed to two sources of finance, debt and equity. So we are taking that EBIT in the numerator and divide it by value of the firm. You will get overall cost of capital. Now we have seen how to know these three items: capital structure, value of the firm, and overall cost of capital. And once again, what this theory states is uses of maximum possible debt, and if possible use 100% debt. Again, let's see this graph once again. If you observe, the overall cost of capital is minimum if you use 100% debt. Hope you understood this net income approach. If there are any doubts, any suggestions, please leave it in the comment section. If you like my video, please don't forget to give a like because it will give me a boost to do much more videos. Share this video and don't forget to subscribe. And one more thing, if you hit the bell icon, you will get notification whenever I publish a new video. This is for today. Let's meet in our next video. Signing off. Bye.